Welcome to the audiobook for free. How to Earn Money from Stock or Coin. Voiced by Ava from Clipchamp. Written by author Dai Pham. We start going into the inside of the book.
Now,
Unlock your path to financial freedom with my essential guide to stock market investing. Before we go further into the book, here is the brief introduction to the author. The author began investing in the Vietnamese stock market in 2011. By late 2014, he started exploring the crypto market, and by 2018, he had fully transitioned into cryptocurrency investment. Through numerous encounters with market traps and setbacks, he gained valuable experience. Today, he focuses solely on investing in Bitcoin. His background in the stock market continues to be a valuable asset. If you prefer a market with less volatility, traditional stocks may be the right choice, offering long-term investment opportunities with potentially significant returns. This book shares practical insights drawn from real market experience. Applying these lessons to your own investment strategy can open up opportunities for wealth building and guide you on your path toward financial freedom. It's simple and easy. Summary of some main contents of the book. The book will talk about how to choose a safe stock. Many basic chart models of some companies for you to practice directly. Read carefully and practice thoroughly to gain more experience. Are you ready to dive into the world of stocks and investing? Whether you're a beginner or an experienced trader, our book is crafted to be your trusted companion in navigating the often complex world of stock markets. Designed with clear explanations and easy-to-follow stock charting techniques, this guide provides insights that can transform your approach to trading and investing. In this book, you'll learn fundamental and technical analysis. Understand what time stock prices and learn practical charting strategies to spot market trends. Simple investing techniques. Develop a balanced approach to building wealth, whether you're looking for long-term growth or short-term gains. Step-by-step stocks simple charting. Discover how to interpret charts, identify patterns, and make informed decisions with confidence. Investing doesn't have to be daunting or reserved for professionals. This book breaks down complex concepts into digestible steps, empowering you to take control of your stock choice. Don't miss out the simple way on an opportunity to enhance your skills and make smarter investment choices. Ready to start your journey? Learn method on this book today and step confidently into the world of stocks and investments. What beginners need to know when entering stock investing with a desire. Entering the world of stock investing can be a challenging experience, yet it offers valuable opportunities for those seeking to grow their personal wealth in a long time. For beginners, the most important thing to remember is that knowledge is key. Investing without a deep understanding of the market can lead to poor decisions and high risks. Here are some essential points beginners should consider. From my perspective, someone who has invested in the Bitcoin field for more than 7 years. And with what I share in this book, you should only consider it as a method for reference and test it for a certain period of time before you can try to apply it to your own strategy. Understand the nature of investing. Stock investing is not a get-rich-quick scheme. It requires patience, discipline, and a well-thought-out strategy over a long period of time. It can be several days to several weeks. Even an investment project can last for several months to be able to give the final results. Expecting immediate profits can easily lead to disappointment, and failure can wipe out your assets with high-leverage strategy. Learn fundamental and technical analysis. Understanding financial reports and key metrics like total debt-equity ratios and EPS can help you assess a stock's value. Technical analysis, such as reading charts, will also give you insight into trends and potential entry points. For companies where the EPS is shown as 0, it means that the company has retained its operating profits and turned that stock into a stock with the potential to increase in value in the future. This is only true for large, profitable companies that are shown in their quarterly financial reports and cannot be applied to all. When a company's EPS, earnings per share, is shown as 0, it doesn't necessarily mean that it has retained its profits to increase stock value. A 0 or near-zero EPS typically means the company did not generate any net income or had very low net income during that period, or that its net income was balanced out by its expenses, resulting in no earnings left to attribute per share. Here are some possibilities behind a zero EPS. No profit or a loss. The company might not be profitable yet or could be reinvesting heavily in its operations, which reduces reported profits. High expenses. The company's expenses might have been high enough to offset its revenues, resulting in little or no net income to allocate as earnings per share. Early stage or growth companies. Some startups or high-growth companies, especially in sectors like tech, might focus on growth over profitability. They reinvest revenues back into the business, e.g., for R&D or expansion, instead of focusing on immediate profits. Non-cash expenses. In some cases, non-cash expenses like depreciation or stock-based compensation may reduce net income, even if the company has a healthy cash flow. A zero EPS doesn't imply that the stock will automatically increase in value in the future. Investors might still see potential in such companies if they expect future growth, but an EPS of zero is more a reflection of the current lack of profitability rather than an indicator of retained earnings for future stock appreciation. For companies like that, you can only check and monitor based on the price performance displayed on the Japanese candlestick chart, because whether the company is really good or not is shown on the price of that company. If EPS is zero but the company's price is continuously growing, it proves that this is a profitable company. This is my view. If EPS is zero but the company's price is continuously decreasing, it is a sign of the decline in the company's business situation. It is best to remove this company from your observation list. What is my view on total debt equity? When you look at the published financial statements, you will see the percent. In my view, if this ratio exceeds 50%, it means that this company is not very safe. If the debt exceeds 100%, it means that this is a risky company. It is best not to touch. There are also some companies with ratios below 60%. You can also reluctantly accept it because of its potential in the future. Here I will take a specific example of Amazon company stock with code Amazon. When looking at total debt equity, you will see a debt level above 50%. And with the criteria of safety, with the current debt level, it will be eliminated from the investment portfolio. But when looking back at the company's business situation report with good profit performance, with a debt level below 60%, it can still be said to be a good choice. There are pictures at here. Let's buy the printed book to read more carefully. Data picture is taken from the page finance.yahoo.com. Some industries, such as real estate or energy, tend to have higher debt ratios due to the nature of their business models, while others, such as technology, may have lower debt ratios. During recessions, a high debt ratio can be a warning sign, while during growth periods, it can be an opportunity. There is no single number for a good or bad total debt equity ratio, but it is important to consider the ratio in the context of each company, industry, and current economic conditions. Compare it to similar companies and review the company's financial history to make a more comprehensive assessment. Anyway, I will always choose companies with debt ratio lower than 60% because then I will feel safe and secure. And an extremely important thing in investing. When everything is good, everything is favorable, but the price of that company keeps signaling a decline, and the basic indicators also talk about that decline, then you should not hesitate to close that investment, even if it is a loss. Many legendary investors always emphasize that cutting losses to protect assets is the best strategy when the situation turns bad. This is absolutely correct, and you must apply it. Do not let the loss be bigger even if you have invested in a stock of a large and very good company. We cannot know how long that decline can last if we still hold on hoping for the day when the price will return to the break-even point. What if that never happens? The price keeps falling to new levels, making the loss even bigger. Therefore, closing the loss is always the best strategy, much more than how much profit has been made on that investment project. So we have finished the part of finding a potential company to add to the portfolio. The next thing is to look at the chart and the basic indicators. This is the most important part of investing. Buying stocks is not only for the dividend that the company pays us every year, but also for the future increase in the price of the stock. The increase in the price of the stock is what brings the greatest profit that investors expect. Why investors buy stocks? Beyond dividends to future growth. Investing in stocks is about much more than the dividends a company might pay each year. While dividends provide a steady income and can be an appealing feature for many investors, the true potential of stock investing lies in the possibility of future price appreciation. When a company grows, its stock price often rises, driven by increased earnings, market expansion, or successful new products. This price appreciation can lead to significant returns over time, far exceeding the initial investment. Unlike dividends, which are typically paid on a regular schedule, price gains are realized when you sell the stock, ideally at a much higher price than you paid. This potential for price growth is what draws many investors to the stock market. While dividends may provide a steady, reliable income, the greatest profits often come from long-term stock appreciation. Companies that reinvest their earnings into growth through innovation, acquisitions, or expansion create value that is reflected in rising stock prices. For investors, this means the chance to build wealth as the company's value grows. In essence, buying stocks isn't just about today's returns, but about positioning yourself to benefit from tomorrow's growth. It's about believing in the company's potential and having the patience to see it through. This combination of dividends and price appreciation is what makes stocks one of the most powerful tools for building wealth over time. This is also true for companies in the cryptocurrency space. But because it is so manipulative, my book does not recommend you to get involved in this space unless you have many years of experience. Even I myself, with many years of experience, dare not invest in these cryptocurrency companies, even though they are doing well. The intense price manipulation in the cryptocurrency market. The cryptocurrency market, while highly promising, has often been marred by significant price manipulation. Due to its relatively young age, lack of regulation in many areas, and the presence of anonymous players, cryptocurrencies are more susceptible to price manipulation than traditional assets. For new investors or even seasoned traders, understanding how these manipulations occur can be crucial for making informed decisions and protecting their investments. One of the most common forms of manipulation is the pump and dump scheme. This occurs when a group of individuals or organizations artificially inflates the price of a low-liquidity cryptocurrency by purchasing large amounts, creating a sudden rise in price. This hype, often accompanied by social media posts or news releases, draws in unsuspecting investors who fear missing out. Once the price reaches a peak, the manipulators sell off their coin holdings, causing a rapid price crash that leaves new buyers with losses. The price drop is so severe that in a short period of time, the price can drop more than 100 times or increase more than 100 times. When such events occur, it is difficult for inexperienced or experienced investors to respond promptly. The influence of whales, investors who hold massive amounts of a specific cryptocurrency, is also significant. A single whale's buy or sell action can cause huge price swings due to the large amount of capital they can move. Often, whales will take advantage of lower liquidity markets, where even modest transactions can shift prices dramatically. By selling or buying large amounts strategically, they can manipulate prices in ways that benefit them but hurt smaller investors. Finally, lack of regulatory oversight contributes to this environment of manipulation. Many crypto exchanges operate without the strict regulations that traditional stock exchanges must follow, allowing questionable practices to flourish. Some exchanges are even accused of enabling wash trading. Open parenthesis, where the same party buys and sells to themselves to inflate volume, close parenthesis, which creates a false sense of activity and influences prices. But until then, cryptocurrency remains a volatile and sometimes unpredictable market, where price manipulation is a real risk. This is why you should stay away from this field even though it has many delicious pieces of cake. Now, let's learn about the charts and basic indicators used in this book. It is the most important part of the book. The importance of charts and basic indicators in stock trading. Charts and basic indicators are essential tools for any investor, especially those new to the world of stock trading. They serve as a visual representation of market data, providing insights into stock trends, patterns, and potential entry or exit points. With these tools, investors can make more informed decisions rather than relying purely on instinct or guesswork. Understanding trends and patterns, charts offer a clear view of how a stock has performed over time, showing its highs, lows, and overall trends. By studying price movement patterns, investors can identify whether a stock is in an uptrend, downtrend, or sideways trend. Recognizing these patterns is crucial, as they can signal the best times to buy or sell a stock. In the securities industry, where there is a lot of supervision and strict regulations, stock manipulation is difficult, but there are still many cases of stock manipulation. Therefore, candlestick charts and indicators cannot always give 100% assurance, and there are always certain deviations. Therefore, you should never trust 100% in any indicator, but can only consider it as one aspect, one perspective to better understand the overall situation of the market. Indicators for decision-making. Basic indicators like moving averages, relative strength index, RSI, and MACD, moving average convergence divergence, provide deeper insights into stock momentum and potential reversals. For example, moving averages smooth out price data, helping investors identify the general direction of a stock. The RSI shows whether a stock is overbought or oversold, which can indicate if a trend might reverse soon. MACD, on the other hand, helps traders spot changes in momentum and can confirm trends. The names of the indicators I just mentioned are just examples that many investors use. They are mentioned by me in this book. Basically, charts and basic indicators provide investors with vital tools for analyzing stocks and navigating the market with greater confidence. They help reduce uncertainty, offer insights into market behavior, and improve timing for trades. Because there are so many indicators, all of which have the ability to generate profits, I cannot use them all, so I have filtered out the simplest and most suitable indicator for me to use. Through time, I have been confident in my decisions in the market, so I will share it right away. I have also made many videos on testing the effectiveness of indicators as well as the wrong timing of indicators on YouTube. You can search for reference with the search title as follows: TradeBake Token Playlist Video from @JaiNonHaiChi XS9244. The playlist is also below the description. The following sections of the book contain numerous illustrations, which cannot be included in this audiobook format. Therefore, the audiobook ends here. For full access to all content, please purchase the printed version available on Amazon. Read it carefully and practice the included exercises multiple times to master the skills of making money from stocks or cryptocurrencies.